Today, we are breaking down two growth stocks that are quietly positioning themselves for what could be their next major expansion phase once sentiment flips and capital flows back into beaten-down tech stocks. And what makes this even more interesting is that both companies sit directly inside two of the most powerful consumer behavior shifts in the world today: the shift from traditional entertainment to streaming, and the shift from ownership of content to platform-based access. The market does not reward popularity. It rewards positioning before the inflection point. And right now, both of these businesses are sitting in a zone where fear has compressed their valuations, even though their long-term relevance has not disappeared. In fact, in many ways, it has become even more important. Let us start with the first company. Roku, ticker symbol ROKU, is not just a streaming stock, it is a distribution layer for modern entertainment. Most investors misunderstand Roku because they try to compare it to content companies, but Roku does not need to win the content war. It wins something far more powerful. It wins the access point. Every time someone turns on a smart TV and selects a streaming app, there is a high probability Roku is sitting in that ecosystem, either as the operating system or as the gateway to those services. That positioning matters because it gives Roku something extremely rare in technology. It gives them behavioral lock-in without requiring content ownership. Now here is where things start to get interesting. Over the last couple of years, Roku has gone through a significant reset in growth expectations. Advertising budgets tightened, brands pulled back spending, the broader digital ad market slowed as macro conditions shifted, and because Roku is heavily exposed to advertising revenue through its platform business, the stock took a meaningful hit. At one point, it was down dramatically from its previous highs, reflecting not just short-term weakness, but investor fear that the growth story might be broken. But when you look under the surface, something more important is happening. Roku continues to expand its active user base. Millions of households are still adopting smart TVs, and Roku continues to be embedded in that transition. Even in a slower advertising environment, engagement across its platform remains strong because streaming itself is not slowing down. People are simply shifting where they watch content, and that shift is structural, not cyclical. Now let us talk about the engine that actually drives Roku's long-term upside. Roku operates a dual revenue model. On one side, it earns hardware-related income through device sales, but the real long-term value comes from its platform business, which includes advertising, subscription distribution, and revenue sharing with streaming services. That platform segment is where the compounding effect lives. As more users engage with Roku-powered devices, the company gains more data, more ad inventory, and more leverage over content distribution. This creates a feedback loop. More users lead to more engagement. More engagement leads to more advertisers. More advertisers increase monetization per user. And that metric is critical. Even in slower periods, Roku has historically been able to grow its average revenue per user over time. That is one of the strongest signals of pricing power in a platform business. But here is the emotional part of the story that most investors miss. When a stock is down significantly, the narrative usually turns negative. People start assuming the business itself is declining. But in many cases, what is actually happening is that expectations were simply too high during peak cycles, and the reset creates an opportunity for long-term investors. Roku today is not priced like a dominant platform expanding into its second decade of growth. It is priced more like a company struggling to survive in a saturated market. That gap between perception and reality is where opportunity often lives. And now, the next phase for Roku is not about survival. It is about monetization efficiency. As advertising conditions stabilize, even modest improvements in ad spend can have an outsized impact on Roku's profitability because of its scalable platform structure. You do not need explosive user growth for Roku to work. You need normalization in ad demand and continued engagement across its ecosystem. Because once that happens, leverage kicks in quickly. Now step back and think about what Roku actually represents. It is a company sitting at the center of streaming consumption, owning the interface layer between users and content providers, and gradually increasing monetization across millions of connected households. That is not a broken story. That is a temporarily misunderstood one. And when sentiment shifts, stocks like this do not recover slowly. They tend to reprice quickly when confidence returns. At this point, we are no longer talking about hype. We are talking about structural positioning inside a massive behavioral shift in global entertainment. And that is why Roku remains one of the most closely watched turnaround stories in the growth investing space today. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's shift to a company that has completely changed how the world experiences audio but is still being treated by the market like it is just a music app. Spotify technology, ticker symbol SPOT, is not simply a streaming service. It is one of the most powerful attention platforms ever built in consumer tech. Because while video dominates visual attention, audio dominates everything else in between. Commuting, working out, studying, relaxing, even background listening while working. Spotify sits in all of those moments, and that matters more than most investors realize. Because attention is the foundation of monetization. What Spotify has built is not just a library of songs, it is a global distribution network for audio content, including music, podcasts, and increasingly creator-driven content that behaves more like media ecosystems than simple playlists. Now here is where the real story begins. Spotify has spent years in what the market considers a difficult phase. Growth has slowed compared to its early hyper-expansion years. Costs have been scrutinized, profitability has been inconsistent, and investor sentiment has swung back and forth between optimism and doubt. At one point, Spotify traded at levels that implied it might struggle to ever become meaningfully profitable at scale. But underneath that volatility, something important has been happening. Spotify has been transitioning from a pure growth-at-all-costs company into a more disciplined platform business focused on monetization per user, efficiency, and margin expansion. And that transition is exactly what long-term investors should pay attention to. Let us break down why this business matters at a structural level. Spotify operates on a freemium model. That means it has a massive global base of free users supported by advertising and a large and growing base of premium subscribers who pay monthly fees for an ad-free experience with additional features. This dual structure is critical because it gives Spotify two separate engines of revenue growth. On the premium side, the company benefits from predictable recurring revenue. As subscription pricing gradually adjusts and as more users convert from free to paid, revenue stability improves. On the advertising side, Spotify is still in the early stages of unlocking its full potential. Audio advertising is structurally under-monetized compared to video or social platforms, which means there is significant room for pricing improvement as demand for digital audio inventory increases. And this is where Spotify becomes interesting from a long-term investing perspective. The market often underestimates businesses that have not fully optimized their monetization curves. Spotify is not struggling to find users. It already has hundreds of millions of active listeners globally. The challenge and the opportunity is extracting more value per user without damaging engagement. And so far, Spotify has been executing on that balance. Now let us talk about the moat. Spotify's competitive advantage is not just its music catalog, it is its recommendation engine, personalization algorithms, and user behavior data. The more you use Spotify, the better it understands your listening habits. Over time, this creates switching friction. Not because users cannot leave, but because leaving means losing a deeply personalized listening experience that improves continuously. That is a soft moat, but in consumer platforms, soft moats are often the most powerful, because they are built on habit, not contracts, and habits are incredibly difficult to break. Now let us bring in the financial reality. Spotify has been steadily growing its monthly active users and premium subscribers over time. Revenue has continued to trend upward, even through slower macro periods. The key focus for investors has shifted from pure growth to profitability. And recently, Spotify has shown stronger discipline in cost management, including restructuring efforts and efficiency improvements across content, marketing, and operations. That shift matters because it signals maturity. Early-stage companies prioritize expansion, mature growth companies prioritize sustainable unit economics. Spotify is moving into the second category, and when that transition happens successfully, markets often revalue the business significantly higher because earnings become more predictable. Another important driver is podcasting. Spotify made a major strategic push into podcasting, which initially created skepticism due to acquisition costs and uncertain monetization. But over time, podcasts have become a key engagement driver on the platform. More engagement means more listening time. More listening time means more advertising inventory, and more advertising inventory means more monetization potential. It is a cycle that compounds quietly in the background, and that is exactly what long-term investors should focus on. Not short-term volatility, but long-term expansion of monetizable attention. Now step back and think about what Spotify actually is. It is a global audio ecosystem with massive user scale, increasing monetization per user, improving cost discipline, and multiple revenue streams that are still under-optimized. That combination is powerful, because when sentiment is negative, the market tends to price companies based on recent performance. But when sentiment shifts, it starts pricing future potential, and Spotify has a very large future potential if it continues executing on its current trajectory. This is why investors are watching it closely as a long-term compounding candidate rather than a short-term trade. Because the real question is not whether Spotify is relevant. The real question is how much value it can extract from its existing global attention network over the next decade. And that is where the upside narrative becomes much larger than most people initially assume. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now that we have broken down both businesses individually, it is time to zoom out, because the real edge in investing is not just understanding companies in isolation, it is understanding what they are signaling about the market itself. Roku, ticker symbol Roku, and Spotify Technology, ticker symbol SPOT, are not random growth stocks. They represent two different layers of the modern attention economy. Roku controls distribution. Spotify controls engagement. One owns the gateway to the screen, the other owns the time inside the ears, and when you put those two together, you start to see a larger pattern forming across the entire digital economy. Let us start with what both companies have in common. Both have been heavily punished by the market at different points in time. Both have gone through periods where growth slowed compared to earlier expectations, and both have faced skepticism about whether their best years are already behind them. But here is the key distinction that long-term investors focus on. Temporary slowdown does not equal structural decline. Roku is still embedded in millions of streaming households. The shift from cable to streaming is not reversing, it is expanding, and Roku remains one of the most direct beneficiaries of that transition as long as smart TVs continue to dominate home entertainment. Spotify is still one of the most dominant audio platforms on the planet. Audio consumption is not shrinking. It is expanding into podcasts, creator content, and personalized media experiences that traditional radio never could have delivered at scale. So the real question is not whether these companies are still relevant. The real question is whether the market is correctly pricing their long-term compounding potential. And right now, the answer is uncertain, which is exactly where opportunity often emerges. Now let us talk about sentiment. When stocks decline sharply, investor psychology tends to shift from optimism to doubt and eventually to indifference. That final stage is often where long-term value begins to quietly build again. Because while retail attention moves on, businesses continue to operate, innovate, and adjust their cost structures. Roku has been refining its platform monetization. Spotify has been improving its profitability framework. Both are evolving from pure growth narratives into more balanced growth and efficiency stories. And markets tend to reward that transition once it becomes visible in earnings consistency. Now let us connect the deeper theme here. Both companies are fundamentally tied to attention. Roku monetizes attention through advertising on the largest screen in the home. Spotify monetizes attention through subscription and advertising inside personal audio experiences. Attention is one of the most valuable assets in the modern economy, and both companies sit directly in the flow of it. But here is the nuance most investors miss. Attention alone is not enough. You also need distribution control or behavioral lock-in. Roku has distribution control because it sits at the operating system level of streaming devices. Spotify has behavioral lock-in because it builds personalized listening habits that improve over time. That combination is what creates long-term defensibility. Now let us talk about what could change the trajectory for both. For Roku, the biggest catalyst is advertising recovery and platform monetization efficiency. As digital ad spending stabilizes, even modest improvements can significantly impact profitability due to Roku's scalable structure. For Spotify, the biggest catalyst is continued margin expansion and stronger monetization of both premium subscribers and advertising inventory, especially in podcasts and emerging audio formats. If both companies execute even moderately well, the market could reprice them very differently than where they sit today, because right now, they are still being evaluated based on recent history, not future potential, and that gap is where long-term investors often find their advantage. Now let us bring this home. Investing in growth stocks is not about chasing momentum. It is about identifying businesses that are temporarily misunderstood but structurally positioned in expanding industries. Roku represents the evolution of television into a software-driven, ad-supported ecosystem. Spotify represents the evolution of audio into a global, personalized, on-demand media network. Both are still early in their monetization maturity relative to their user scale. And that is the key insight. Scale exists. Monetization is still evolving, and sentiment is still recovering. When those three forces align over time, that is when compounding becomes most powerful. Now before we end, let us put this into a simple question for reflection. If both Roku and Spotify continue growing their ecosystems over the next decade, improving monetization, and maintaining user engagement, which business do you believe has the stronger long-term advantage in capturing global attention, the screen-based platform or the audio-based platform? Because the answer to that question is not just about these two stocks, it is about where you believe the future of media attention is heading. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now tell me in the comments which of these two businesses do you think has the strongest long-term competitive advantage and why? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.